Ayon Mukhopadhyay of IIFL is here. Ayon, good morning there in London. How are things panning out? I'm told gradually things are opening up and normalcy is returning. Also talk to us about the conversations you're having with your clients there.
Yeah, good afternoon, Ajay. Good afternoon, viewers. I hope you're all keeping safe. Yes, in London, I think the lockdown is almost entering its last legs. And in fact, as the term is in India, I think the unlock phases are now completely in swing. And you might have seen some of the pictures of overcrowded beaches in London. So I would say that more or less from the people's point of view, the lockdown is more or less over. Of course, the risk of a second peak and all that is there, but I think people are not really bothered and pestered about those things right now. Coming to the markets, yes, there has been a global-driven rally that is going on right now, and that is again the whole rally that is happening globally is completely based on the fact that the lockdown will be lifted globally and things will be going back to normal. And I think the other optimism that is being buoyed in is that if you hear what the commentary companies are giving, and obviously companies cannot give an outlook, but what they are trying to say that in the 1 or 2 weeks that the easing has happened, not only just in India but in other places also, that they have been seeing a much sharper recovery than what was expected. And that is, of course, giving buoyancy to the market that, the apocalyptic figures that we had drawn for some industries may not be coming true. And yes, you are right on the point that you touched upon FII selling. FIIs, in fact, for the last 10 days or so, have actually become net buyers in the market. If you can see, of course, this is skewed a lot by the block deals, the large block deals that are happening in the market. But all in all, that helps. And also, when you have a scenario like this where global markets are rallying, people rush to cover their shorts. So that helps in this. So 10,000 is a crucial level. So if Nifty it can decisively break that, you could see, a sort of a sustained rally from there happening.
Right. Ayon, that is correct. On the one hand, we are talking about the pandemic. Let's slow down the dire straits our economy is in. But the way high quality paper and assets are getting absorbed by institutional guys, private equity companies, big funds, as well as players like Facebook, if the way HUL block, QIP of Kotak, and of course now another block from the promoter, the big stake sales in Jio, anything to go by, billions of dollars of emerging markets asset, be it financial paper or real asset, is being absorbed. Is this also got to do with unprecedented amount of liquidity which is sloshing around globally? Is that also a reason that emerging market is witnessing flows?
Well, yes, there is. From the time of the crisis broke in, you have seen unprecedented monetary policies being going globally, and this amount of money has to be chasing somewhere. So what we are seeing here is, and when I speak with my investors here also, that they have been always saying that when they look at India, they look at India from a long-term point of view, and if they are getting companies which they would have anyway invested before the pandemic hit, and they would have had a concern on the valuation point of view, their faith is now more. The faith is more restored, getting those stocks at 20-30% lower than what they would have been. Maybe from the bank's point of view, quality banks from franchise point of view. Of course, there would be near-term pressures on it. There would be near-term NPS pressure on it. But if what they are looking at is they are looking at companies which can sustain this, and the companies that would probably become stronger post the crisis. So that is one way of looking at the way the investors are looking at this horizon. And the second is they're looking at companies where there is a lot of amount of cash on the balance sheet and we can go on. And the third way of investing into this is they're looking at if the world really does change, and this is the beginning of a decade. So what were the themes that would be driving the decade? So that was the fresh investment that are coming into the place where you do not do your kind of investing that you did or originally looking at it from a value point of view, or seeing that how much growth is coming. But the thing is what can be the stocks that can actually ride on the theme point of view and just put money into them and not really look. You cannot have on a valuation metric, you really cannot justify a stock right now, but just play it on a theme that it can be growing in the next 5 to 10 years.
Ayon, talk to us about areas which you are constructive of in this market with a 2 to 3 year view where risk reward is attractive and the markets are mispricing the situation right now.
So the thing is, I think in every sector right now, that you will have pockets of you will have pockets to buy out, and I think there is a valuation differential in every sector that if you look at it. But the way that we are, the way that I think people are looking at is people are still not till there is a clarity on what will happen with the scenario panning out, and because companies really cannot give a guidance, I think people are more comfortable here buying companies which have cash on their balance sheet and not too much over leveraged. But at the same time, as I told you, that if you have companies where you have considerable number of comfortability that these are extremely well-run businesses, and these are businesses which were traditionally extremely expensive to even consider, but you are now getting them, even though optically they might look expensive, that you're getting them 30-40% cheaper than they were 3 months back. I think you should definitely look into buying them, and then you have pockets like this in very high quality private banks, high quality NBFCs. But at the same time, at the cheaper end of the spectrum, I think there are sectors that have been completely beaten down, and I think we are seeing the recovery could be much faster than expected. Our sectors like, for example, cement, which the rally has started to happen from the last 1 month or so. Sectors like building materials, and sectors where we would even see, as I said, even a faster than expected recovery happening. They're been completely bombed out because of the corona crisis, but we can see much faster recovery happening there, and the commentary of those have started to come in currently. So there's a mixed bag type of a portfolio that if you were looking at, and on a long-term thesis, from the very beginning of the year, we definitely like the insurance theme in India. That continues to be a sector that we continue to like, both in the life and the non-life, and we believe the post this crisis, this sector would even emerge stronger. It's a quasi-consumer type of a story for us.
That's a very interesting angle, Ayon, and quite differentiated thoughts you've given. I want you to leave us with your thoughts on the broader markets, because right now the action is focused on the larger markets, but the inquisitiveness to also look in small and mid is also rising among investors. How are you looking at that space?
Yeah, that's what I said, right? So basically, if you look at the sector itself right now, you will find a valuation differential in the huge sector. So in every sector itself, you'll find a valuation differential, and that has been, and whenever you have FIIs coming in, initially the money flows into the large cap stocks, and later on the money flows into the mid cap stocks. So you would always see that when the rally happens, the mid caps. When the fall happens more in the mid caps first, and then when the rally happens later on in the mid cap. So in the mid cap space, you would definitely find a huge amount of valuation differential in sectors. So in sectors where if you can see it can be any sector. It can be sectors such as real estate. It can be sectors as I said, building materials. It can be sectors which provide staffing. It can be sectors which are based on hospitality. Again, these are extremely difficult to invest now. But if you get any comfortability that these sectors will be recovering much faster than normal, because currently the valuation of these sectors are pricing in absolutely doom for them. And if you are comfortable on the balance sheets, this is very careful when you're investing, that if you're careful on the balance sheets not being able to sustain even 6 months of an issue, I think there is incredible pockets of value in some of these companies, some of these sectors that I mentioned. And yes, there is a huge dichotomy in the valuation differential between some of mid-cap companies and the larger companies. But there are certain sectors where, we all know that people do not have any confidence in investing right now. Like for example, the smaller NBFCs, the lower rated NBFCs. I think there is absolutely no confidence in investing right now, and probably rightly so, because there is no even after the clarification with the finance minister and saying, I think there really isn't a risk on trade there to be investing in those sectors. But the other sectors I mentioned to you, I think if there is a faster than expected recovery after the unlocking phases happen one after the other, I think you could see a sharp rally in them.
Right. All right, Ayon, we'll let you go on that one. Thanks so much for your time today coming on the show. But meanwhile,